This week, a cheap Chinese artificial intelligence model wiped $3.3 trillion off chip stocks in days. And everyone said the exact same thing. The artificial intelligence bubble finally popped. That take isn't just wrong. It's got the whole story backwards, because the market just sold the wrong half of the trade. Let me show you. Okay, set the stage. Because this matters. For 2 solid years, there was basically one rule in this market: pay up for compute. The more chips a company bought, the more expensive its build-out, the more the market loved it. Nvidia sold the shovels, so Nvidia went to the moon and became the most valuable company on Earth. The entire trade ran on one word: more. More spending, more chips, more compute. Forever. And then this week, a lab in China broke the rule. The lab is called Moonshot, and the model is Kimi K3. It's open, meaning anyone can download it and run it cheaply, and it scored at or near the very best models in the world. In plain English, frontier-level artificial intelligence for a fraction of the price. Wall Street took one look and panicked. If you don't need to spend a fortune on compute to get to the frontier, then all those hundreds of billions in chip orders suddenly look like too much. So they sold. $3.3 trillion gone from chip stocks, and the whole semiconductor index dropped into a bear market. They're calling it the second DeepSeek moment. But here's the twist the panic missed completely. Cheap artificial intelligence is not the end of artificial intelligence. It's the end of the shovel seller's pricing power. Think about a real gold rush. If somebody invents a shovel that's 10 times cheaper, is that bad news for the gold rush? Of course not. It's bad news for the one company that got rich selling expensive shovels. For everybody actually digging for gold, cheaper tools are the best thing that could possibly happen. That's exactly what's happening here. When intelligence gets cheap, the loser is the toll collector on expensive compute. But the winner is everyone who buys intelligence and turns it into a product. Every app, every software company, every business that runs on artificial intelligence just got its single biggest cost slashed. So that $3.3 trillion didn't evaporate. It's looking for a new home. It's hunting the companies that profit when the intelligence itself is basically free. The value didn't leave the trade. It moved. And if you still think this was about demand drying up, look at this. Taiwan Semiconductor, the company that physically makes the world's most advanced chips, reported earnings this same week. Operating profit up 77%. A record quarter. And it raised its guidance for the whole year. That is the company at the dead center of artificial intelligence telling you, out loud, demand is speeding up, not slowing down. The textbook says the stock rips. Instead, it fell about 7%. Read that again. Best possible earnings, and the market sold it. That's not a demand problem. That's the market repricing what it's willing to pay for. So watch what the crowd is actually doing. It's selling artificial intelligence stocks to pile into Coca-Cola, Procter & Gamble, and cash. And on the same tape, Apple, the one giant that spends the least on artificial intelligence of anybody, quietly retook the crown as the most valuable company in the world. Apple's up about 22% this year. Nvidia, the company the whole build-out runs through, up just 7%, and dethroned. The market isn't voting against artificial intelligence. It's voting for whoever gets the benefit without paying the bill. It's just doing it in the clumsiest way possible, by panic selling the wrong half of the trade. Now let me argue against myself, because if I don't, I'm just selling you a comfortable story. There are real ways this read is wrong. 1. Maybe cheap models compress margins for everyone, not just the chip makers, and the whole complex deserves to be lower. 2. Rotations and tops look identical at the start, and a flight into Coca-Cola is exactly what a late-cycle market does right before it rolls over. And 3. We don't actually know yet if Kimi K3's benchmark claims hold up. The full model drops July 27th, and that's the real test. So I'm not telling you it's all clear. I'm telling you the popular headline, "Artificial intelligence is over," is the one thing the evidence doesn't support. So here's the test, and I'm putting it on the record. This gets settled next week when the artificial intelligence monetizers report. Microsoft, Alphabet, Meta, Amazon. If cheaper intelligence is really a disaster, they miss or they warn, and I'm wrong, But if it's what I think it is, the companies that buy intelligence and sell products hold up just fine, maybe even better, because their biggest cost just fell. My call. At least two of the big monetizers beat, and the idea that artificial intelligence spending never turns into profit gets challenged, not confirmed. If they miss, I'll say so. Right here. That's the deal. The most dangerous moment in any boom isn't when it ends. It's when it changes shape, and everybody mistakes the new shape for the end. Artificial intelligence didn't get less valuable this week. It got cheaper. And cheaper is only scary if the only thing you own is the expensive shovel. So the next time a headline screams the bubble popped, ask a better question. Is this the gold rush ending, or just the market finally noticing the shovel got cheaper? Earl's full daily brief is on the channel. I'm Frankie, the asymmetric signal. One contrarian read a day. Subscribe.